I'm Basil Nilamra, tutor for Audit and Assurance. In this video, I'm going to debrief Section A part of September 2024 mock exam, Audit and Assurance. So as you know, the Section A of Audit and Assurance contain 3 objective type questions. And each objective type question will contain 5 objective type questions, and each question carries 2 marks. So the objective type question, section A, carries 30 marks that you already know. The most important questions that ACCA very frequently test in section A are ethics, governance, that is corporate governance, ISA 570 going concern, and ISA 560 subsequent events. So having a thorough knowledge in these areas will really help you to score outstanding marks in section A part of the exam. So without wasting our time, let's start with the section A, the first question. So the first question is related to ethics. Your firm, Bond and Company, has 8 partners and has been invited by Mr. Smith, the managing director and majority shareholder of Salvation PLC, to accept appointment as statutory auditor of the company. Salvation is a listed company and its principal activities manufacture and distribution of healthcare product. The present firm of auditors will not be reappointed for the next year's audit. So the question very clearly has stated that Salvation is a listed company. It's very important to understand that particular terminology or statement. Why? Because you might have learned in professional ethics, an external auditor of a listed company is prohibited from offering certain services to the listed company, as well as being audited at the same time. 1. An external auditor of a listed company cannot prepare accounting records or financial statements of the listed company. An auditor of a listed company cannot be involved in tax calculation of that listed company. So the services are prohibited for an external auditor to offer to a listed company, as well as being auditor at the same time. And there is also a self-interest threat if the percentage of fees of a listed company is 15% or more for a consecutive 2 years. So it is very important to understand that terminology. It's a listed company. And its principal activity is manufacture and distribution of healthcare product. Your firm has several companies operating in healthcare sector as client. So definitely there could be a conflict of interest, including Combustion Company. Combustion is a large private company and has been a prominent client of your firm for several years. It is involved in manufacture and distribution of healthcare products that are often very similar to products offered by Salvation Company. In addition to statutory audit, Mr. Smith has requested that your firm assess with Salvation corporate tax computation fee, for which it will be very significant. The management at Salvation has asked if your firm would be interested in entering into a formal arrangement to promote their shares to potential investors. The firm will be paid a commission based on number of shares sold. Mr. Smith also suggested that a partner of your firm other than the audit engagement partner of Salvation join the board as a non-executive director. The first question is asking you to identify by clicking on the relevant boxes in the table below whether each of the statements relating to possible threats to bond and company's independence is true or false. A familiarity threat exists due to Mr. Smith's request for the firm assistance in Salvation's corporate tax computation. As this is a listed client, the threat is so significant that no safeguard is possible. It is false because asking or requesting the auditor to assist in tax calculation is a self-review threat. It's not a familiarity threat. So that statement is false. Second one, An advocacy threat exists due to Salvation's management's offer of a formal arrangement to promote their shares to potential investors. The firm can only accept if the commission from arrangement is immaterial. It's an advocacy threat, no doubt. Promoting the position of a client is an advocacy threat. And they're asking auditor to promote shares to potential investors. So definitely it's an advocacy threat. But there is no safeguard for an advocacy threat. They're saying that the firm can accept this if the commission for this arrangement is immaterial. That is completely wrong. Whether the fees is material, whether the commission is material or immaterial, it is irrelevant. There is no safeguard for an advocacy threat. So the audit cannot be the service cannot be accepted at all by the external auditor. The next one, a self-interest threat arises if a partner from your firm other than the audit engagement partner of Salvation joins the board of Salvation as a non-executive director. This can be accepted as Salvation audit partner will not be involved. That is also false. The first statement is actually true. A self-interest threat arises. Yes. If a partner joins a client as a non-executive director, there's a self-interest threat as well as a self-review threat. That is true. But if a partner is on a client board, there is no safeguard. It cannot be accepted at all. So all the statements are false. Next, which of the following factors would be relevant to your firm in their decision on whether or not to accept Salvation's audit engagement? The audit team members might not have required experience and skills required to audit this specialized sector. Given the nature of business, the auditors may not be aware of financial reporting framework used to prepare Salvation's financial statement. Bond and Company, that is the auditor, will have to inquire from Salvation's management and outgoing auditor the reasons behind not reappointing previous auditors. D, the audit fee offered for assignments may give rise to a self-interest threat that may exceed the threshold allowed by ACCA Code of Ethics. Safeguards will need to be implemented in the current year. So the first one is, which of the following factors would be relevant to your firm in their decision on whether or not to accept audit engagement? The first statement says that audit team members might not have required experience. That is entirely false. The second paragraph of the scenario very clearly says that your firm has several companies operating in the healthcare sectors. So already the audit team members will be quite familiar with the healthcare sector, which is basically Salvation's business. So that is wrong. Given the nature of business, auditor may not be aware of financial reporting framework used to prepare Salvation's financial statement. That is again is wrong. Salvation's principal activities manufacture and distribution of healthcare products. And Bond and Company, the firm has several companies operating in the healthcare sector as client. So definitely auditor will be aware of all the financial reporting framework applicable to Salvation and such healthcare sector. So auditor is not required to consider that as well. Now, in accepting the audit engagement, definitely auditor will have to inquire Salvation's management and outgoing auditor the reasons behind not reappointing previous auditor. This is a topic related to procedures before accepting an audit. Before accepting an audit, auditor will have to verify if they have the expertise, capacity, that is knowledge and staff to do the audit, whether they are independent. Is there any conflict of interest? If so, it should be avoided. Auditor have to consider the integrity of management, internal controls, whether there was any fraud or non-compliance with laws and regulation, complexity of transaction. Then the next point is that auditor will have to contact previous auditor. Contacting previous auditor is one of the procedures before accepting audit. So this is deciding whether your firm should accept or not accept Salvation's audit. So it's an audit, it is procedures before accepting audit. So option C, the auditor, bond and company will have to inquire from Salvation's management and outgoing auditor the reasons for not reappointing the previous auditor. The third question, identify by clicking on relevant boxes in the table below whether each statement is true or false. If bond and company accept the audit of Salvation, they will have to withdraw from audit of compassion as there will be a conflict of interest. It's false. If bond is going to accept Salvation as well as their competitor, yes, there's a conflict of interest, but it can be accepted with safeguards. There are certain safeguards when there is conflict of interest between competing clients. It can be accepted with safeguard. The safeguards are inform dostia with governance of both the companies. Advise one or both the companies to seek additional independent audit advice. Use separate engagement team for audit of both the company's Salvation and compassion. Sign confidentiality agreement with the audit team members of Salvation and compassion. Give clear guidelines on confidentiality to the audit team members. And a senior auditor who is not involved in audit of both the companies should review if these safeguards are followed or not. So competing clients, the audit can be accepted with safeguard. So the statement is false. The statement is saying that they have to withdraw from the audit of compassion. That is false. It can be accepted with safeguard. Bond and company will communicate with previous auditor to know areas of concern, if any, which they must consider before audit engagement. That is true. Auditor will have to communicate with previous auditor before accepting the engagement. Bond and company should accept the audit engagement only if it has been confirmed and established that preconditions to audit are present. Yes, audit can be accepted only if the preconditions to audit are present. It's true. Moving to the fourth question. Mr. Smith was at a formal dinner with the partners of Bond and Company, where he informed the partners that while the additional services will be lucrative, a clean bill of health in audit would be crucial for Bond to obtain this additional assignment. So they are saying that we need a clean bill of health, means we need an unmodified opinion, no issues, etc. Which of the following is a relevant ethical threat related to Mr. Smith's statement to be considered before accepting the audit? Self-interest, management threat, self-review, and professional competence and due care. It's a self-interest threat. Why is it a self-interest threat? It's a self-interest threat because auditor might agree to that statement and issue an unmodified opinion, or not asking too many questions to obtain that audit of a listed company, which will be definitely lucrative. So it's a self-interest threat. The fifth one, a conflict of interest arises when an audit firm provides a service in relation to two or more clients whose interest in respect of matter are in conflict. In all cases of conflict of interest, the audit firm should make full disclosure to both parties and ask them both to confirm that they give permission in writing for the services to be provided. If consent by both parties were to be provided, which of the following safeguards are recommended by Code of Ethics to minimize ethical threat? We just discussed that in the third question. Having a separate engagement team who are provided with clear policies and procedures on maintaining confidentiality. Yes, definitely one should be there. Having an appropriate reviewer who is not involved in providing either services to the two clients to review work performed? Yes, it should be there. Establishing a separation of confidential information physically and electronically. Yes, it should be there. So 1, 2, and 3 should be definitely there. A post-issuance review to be conducted for both clients by an external accountant or a regulatory body. No. 1, 2, and 3 are the safeguards where there is conflict of interest. So the first scenario is over. We are to the second scenario. It is 1st July X5. Your firm is the external auditor of Macbeth for the year ended 30th April X5, and the audit for the year is nearly complete. Macbeth provides scientific services to a wide range of clients, which include testing food for illegal additives and providing forensics analysis on items used to commit crimes to assist law enforcement. Macbeth income has fallen due to adverse effect of two high-profile court cases where Macbeth forensic analysis service were found to be in error. Not only did this provide bad publicity for them, a number of significant clients withdrew their contract. Some senior employees then left the company, stating lack of investment in new analysis machine was increasing risk of incorrect information being provided. Management assessment of Macbeth's ability to continue as going concern covers period to 31st January X6. This is a very frequently asked and tested scenario, going concern. As you can see that the year ended is 30th April X5, and they're assessing Macbeth's going concern till 31st January X6. It should be assessed for 12 months. That means it should be assessed from 30th April X5 to 30th April X6, 12-month going concern assessment. A cash flow forecast prepared by management for this period shows Macbeth requiring significant additional cash to maintain the current level of service. Consequently, Macbeth has desired to apply for a loan to ensure sufficient cash for operations in the next year. Your firm has been asked to provide an assurance report on cash flow forecast, which will be used in loan application. Which of the following actions should your firm take in relation to Macbeth's going concern assessment? Request that management extend the assessment period to 31st March X6. Request that management extend assessment to 30th April X6. Yes. The year end is 30th April X5. So the going concern should be assessed for 12 months. That is till 30th April X6. Option B is the answer. Seventh question. Your firm, Macbeth's auditors, have been asked to provide assurance on cash flow forecast. Which two of these statements below regarding assurance provided by auditor on cash flow forecast are correct? Very simple. In case of cash flow forecast, auditor will provide a limited assurance and it should be a negative assurance. Limited assurance will always be given as negative assurance. So option C will be definitely the answer. Limited assurance will be provided by auditors on cash flow forecast and a negative conclusion would be included in the report. Option A is not the answer. The auditor would give reasonable assurance. No, reasonable assurance will be given only for an external audit. This will be an agreed upon procedure as it is based on estimates made by management. Therefore, no assurance will be provided. That is again wrong. It's not an agreed upon procedure. The auditors would need to gather sufficient evidence to form a conclusion. Yes, it's a limited review engagement. It's a negative assurance being provided. So auditor will have to gain sufficient appropriate evidence to form the conclusion. 3 and 4 will be the two statements that is true. Eighth question. Which of the following audit procedure should auditor perform in assessing whether or not Macbeth is a going concern? So they're asking audit procedures to confirm going concern related to Macbeth. It's a scenario-based question. Obtain Macbeth statement of cash flows, review cash inflows and outflows, and assess the assumptions for reasonableness. Evaluate management's plan for future action, including their contingency plan in case the loan application is not approved, and consider the feasibility of these plans. Review company's post-year-end sales and order book to assess if level of trades are likely to increase, and if revenue figures in cash flow forecast are reasonable. Fourth one, review management accounts for the quarter entered 30th April X5 to assess if it is in line with cash flow forecast. Option 1 is wrong. Why is it wrong? Obtain Macbeth statement of cash flows. That is wrong. Review the cash inflows and outflows and assess assumption for reasonableness. Almost a same type of audit procedure you might have learned in the audit procedure chapter. But you have to understand, obtain Macbeth statement of cash flows. No. Statement of cash flow forecast is what auditor will review. To test the going concern, auditor will have to review statement of cash forecast, profit forecast, then review the inflows and outflows of the forecast to assess the assumptions of reasonables in the cash flow or profit forecast. The option number 1 is not stating forecast. It is stating cash flows. To assess going concern, cash flows is not what auditor will verify. It will be cash flow forecast. So option 1 is wrong. Option 2 is definitely the answer. Auditor will have to evaluate management future action, particularly the contingency plan if loan is not obtained. Because the going concern is based on whether the entity will obtain the loan or not. So what if they not obtain the loan? What is their plan B? So 2 will be definitely the answer. And review the company's post-year-end sales order to verify if they have received any new clients, and increase in revenue will be definitely an audit procedure. So 2 and 3 will be there. Review management accounts for the quarter ended 30th April X5 to assess if it is in line with cash flow forecast. No. Because we need to know the forecast, not the year ended. Year ended auditor is auditing. Going concern is all about the next 12 months, whether the entities will be having enough cash flow forecast, will be having enough profit forecast, etc. So auditor will be concerned more into knowing the future forecast, not the year-ended financial statement. So 2 and 3 is the going concern or going concern audit procedures. Ninth one, which of the following statement is incorrect regarding auditor's responsibility in relation to going concern? Evaluate management assessment of company's ability to continue going concern. That is auditor's responsibility. Remain alert throughout the audit for events or conditions that may cast significant doubt on company's ability to continue as a going concern. That is also auditor's responsibility. Obtain sufficient appropriate audit evidence to determine whether a material uncertainty exists, which may cast doubt on company's ability to continue as a going concern. That is also an auditor's responsibility. So definitely decide whether or not company will prepare its financial statement using going concern basis of accounting. It's not auditor's responsibility. Preparation of financial statement is management's responsibility. So option D is incorrect. Statement D is incorrect. So option D is the answer. The last question of scenario number 2, question number 10. The auditors have concluded that there's a material uncertainty related to going concern. The management has included a disclosure regarding material uncertainty in financial statement. Which of the following statement, audit opinion, and audit report is correct? If material uncertainty is adequately disclosed in the financial statement, auditors will give an unmodified opinion and will include an emphasis of matter paragraph. That is wrong. If material uncertainty is adequately disclosed, yes, auditor will give an unmodified opinion, but not an emphasis of matter paragraph. So statement number 1 is wrong. Second statement, if material uncertainty is not adequately disclosed, auditor will give a qualified opinion and will include a material uncertainty related to going concern paragraph in the audit report. Might be true. We have to check the other options as well. If material uncertainty is not adequately disclosed in financial statement, auditors will give an adverse opinion and will include an emphasis of matter paragraph. No, not an adverse opinion and not an emphasis of matter paragraph. No. Because adverse opinion is given when going concern is not appropriate. The last option, if material uncertainty is adequately disclosed in financial statement, auditors will give an unmodified opinion, that's true, and will include a material uncertainty related to going concern paragraph in the audit report referring to disclosure note in financial statement. Yes, that is true. That is true. Auditor will issue an unmodified opinion if it is adequately disclosed. And auditor will also state a material uncertainty related to going concern paragraph. So the D option is the correct one. Now the last scenario-based question. It is 1st July X5. Your firm is the external auditor of Fangone Forest Furniture Company for the year ended 31st March X5. FFF has been trading for over 20 years and manufactures and sells tables and chairs. Current liabilities are shown to FFF statement of financial position as follows. Trade payable X4 and X5 is given. Accruals 61 and 67, X4 and X5, and provision for legal action is also given. The provision for legal action related to a claim from a customer who suffered an injury while assembling a chair supplied by FFF. The directors of FFF dispute the claim, although they are recommending an out-of-court settlement to avoid damaging publicity against FFF. Which two of the statement below are correct generalization regarding the factors which will influence auditor's judgment concerning sufficiency of audit evidence? So it is related to ISA 500 audit evidence. Less evidence will normally be collected on items that have been assessed as high risk. No, that is wrong. If it's a high risk, more evidence have to be collected. So the first statement itself is wrong. Where accounting and controlling systems are poor, more audit evidence is required. That is true. If accounting and internal control systems are poor, we have to obtain more evidence. Where auditor has good past knowledge of the business and trust the integrity of staff, less evidence will be required. It's also true. Where findings related from audit procedures are satisfactory, more evidence will be collected. No. If the findings are satisfactory, then there is no need for more evidence. So statement number 2 and 3 are correct. 12th question. In the audit of trade payable, which of the following is correct reason for the procedure using automated audit tools and technique, that is CAT, obtain a list of all debit balance and obtain an explanation from the client? So obtain a list of all debit balance and obtain an explanation from the client, which is the correct procedure. What is the reason for that procedure? Obtain a list of trade payable, particularly debit balances, and obtaining an explanation. What's the reason for that? This will assess completeness of recording of purchase invoice. No. This will confirm why balance arose and help reclassify amount as receivable. Yes, that is correct. Because a trade payable will normally have a credit balance. If they have a debit balance, it could be receivable. So mostly B will be the answer, but we have to read C and D to confirm that. This will agree payable balance to independent third-party evidence to confirm accuracy, completeness, and existence. Absolutely no. That is obtaining external confirmation, not obtaining a list of debit balances. So that is wrong. The D, this will confirm goods delivered to customers close to the event have been recorded in correct accounting period. No. So the reason for obtaining list of debit balances and obtaining the explanation is that trade payable will not have debit balance. Trade payable will have credit balance. So maybe this have to be reclassified as receivable. Option B is the correct answer. The 13th question is again asking about whether the audit procedures are appropriate or not appropriate. So review payments after year-end to determine whether any accruals are required. This will confirm classification of accruals listing. No, it's not classification. It actually ensures appropriateness, completeness. Reviewing after your payment is to confirm completeness, not to confirm classification. So to confirm classification, it's not an appropriate audit procedure. Recalculate a sample of individual accruals and match to supporting documentation to ensure accrual has been correctly calculated. Therefore, testing for under or overstatement of each accrual. That is correct. Recalculation ensures accuracy. So recalculate to confirm it is correctly calculated. So it's an appropriate audit procedure. Agree accruals to payment made after the year end to ensure accuracy of balance and confirm that accruals are genuine. Yes. Agreeing accruals to payment after the year end, reviewing payments after the year end ensures that the amounts are accurate as well as confirms that accruals are actually there. It's not a fraud, so it's an appropriate audit procedure. The second last one, 14th one. Which of the following procedures on provision of legal action is correct? Discuss the provision with directors to evaluate whether the company is liable for payment and confirm that an out-of-court settlement is appropriate. So legal case directors are disputing the claim, but they are recommending an out-of-court settlement. So a provision has to be recorded. So discuss a provision with directors to evaluate whether the company is liable for payment and confirm that an out-of-court settlement is appropriate. So that is true. It's a correct audit procedure. They're asking us incorrect procedure. So that's not the answer. Obtain a letter from FFF lawyers to provide evidence of whether FFF may be liable for payment and check the amount provided is approximately correct. That's an audit procedure for legal case. For legal case, obtaining lawyer's confirmation is an appropriate audit procedure. So that is also not the answer. They're asking which of the procedures is incorrect. Review any correspondence with customer to help determine FFF liability and determine whether customer may accept out-of-court settlement. That is also an audit procedure which is relevant for legal action. So definitely the D is the incorrect one. So option D will be the answer. If possible, trace payment made before the end of year to receipt from the customer, stating payment is accepted in full and final settlement. There is no other payment are expected to be made. That is not an audit procedure related to legal action. So D is the answer. So the last question. Which two of the following are substantive analytical procedures for wage and salary? Trace and agree total wages and salary expense per payroll to draft financial statement. Recalculate gross and net pay for sample of employee. Agree to payroll record and investigate differences. Compare current year total payroll with previous year and investigate difference kind of ratio analysis. It's an analytical procedure. Perform a proof in total calculation and compare to expected expense to actual with draft financial statement. That is also an analytical procedure. It's reasonableness test. So we have learned that analytical procedure includes ratio analysis, trend analysis, reasonableness test, and examining related accounts. So the C is a kind of ratio analysis comparing payroll with previous year. And the last one, perform a proof in total, is actually a reasonableness test. So option C and D is the answer. So thank you, everyone. I hope you have understood this particular topic, that is ethics, going concern, and a few substantive procedures related question. All the best for your examination. Goodbye.